think there would be a sentimental rub-off even in the bond market, which I think is visible. Nifty started with a pinch of green. Hello. The breath is looking positive, and things are not looking bad at all for PSU banks also. IOB is off to a good start. You've got an uptick which is there in UCO Bank. You've got uptick which is also clearly visible in the entire banking, in the entire liquid universe, so to speak, if I may use that categorization. In terms of the value, which is what I always look at to understand a big trend there, nothing big actually. There is a PNB Gilts. PNB Gilts has shot up. I think you would actually see implications for companies, PNB Gilts. I mean, it is into brokerage of bonds and it is into all that. It's got a big book also in terms of managing treasury portfolios. So more money coming via the bond market, will PNB Gilts gain? It could. So that is one reaction which would be there. But more money coming via the bond market definitely is big news and great news for institutional investors and for the market per se. Nothing big which could be called as a very big trend. I'm really staring at the screen to see if there are any big absolute gainers here. Not too many absolute gainers here, not too many absolute losers here also, Asha.
Yeah, banks actually, that's where all the gains are happening. They were the beaten down ones and they were the drag points for the indexes in the last, 2 odd trading sessions. And they are the ones which are on a recovery. Look at SBI, 1.25% uptick coming in there. IndusInd Bank is the other one, which is a big winner. I can see green on Kotak Bank as well. Let's see what HDFC Bank 2 is up to. And then what the big crack from yesterday, that's ICICI Bank 2 is doing. Those stocks will just come off you on your screens next. HDFC Bank, at least the fall has stalled, if not a meaningful recovery. Though for ICICI Bank, it continues a little bit soft. PSU banks, that's where you are seeing the bigger action really coming in. Let's see what Glenmark 2 is up to. That stock will just come up for you on your screens after that deal with Nirma. That stock is actually lower by about 1.5% as we speak right now. Nikun just flagged off PNB Gilts. There are a whole host of other stocks as well. Glenmark Life, which is down 2%, like I just highlighted. Let's see what ICICI Lombard 2 is up to. There's been a resignation from Bhargav Das Gupta as the MD and CEO of the company. I don't know if it'll really see any material impact. 1.5% lower on that stock as we speak right now. There's Suntech Realty as well, which is partnered with IFC to create a joint platform of about 750 odd crore rupees investment. That's also not seeing much of a reaction. But banks, that's where the big recovery is, and that's the one which is actually pulling or holding at least the Nifty afloat at that absolutely flat juncture, that of 19,750. So that's where you're seeing the meaningful gains coming in. And I think L&T, etc. as well have started off in the green. I can see a green tick coming in on the Adani names, Adani Ports, Adani Enterprises as well. Maruti 2 has started off in the green. Let's check in on what M&M 2 is up to, because yesterday, remember, this was a big drag. So let's see whether there's any recovery there. So largely it's the rate sensitives which are actually holding the ship afloat. Kunal, where does it go from here? And I first want to call on the index, whether this seems like the fall could have been stalled at least for the near term.
Yeah, it looks like, I think for the very immediate term, hopefully if we just hold on to this level for the first hour or so, we could probably have stalled the fall, or at least the intensity of that sell-off should subside significantly for the index. But I think it all depends on how the first hour sets off, whether there is more of risk off which happens, leverage which gets cut, or whether there is long built-up formation which happens onto the stock-specific front. Now, in terms of opening trade, I believe Adani Ports could actually be a good stock to chip into. The stock did pretty well yesterday, so that's a stock I think at 830-35 levels which I would look to buy.
Okay, Shivangi, what are your thoughts on the market move, in particular, getting a take on some of the banks in trade?
So PSU banks are looking quite positive, and we've already discussed Indian Bank from that space. So that is one stock which is looking quite, positive for 420 odd levels. Now, apart from that, some of the paint stocks are also looking quite positive. On my radar is both Asian and Berger Paint, but Berger Paint is looking quite more attractive at these levels. Weekly, we've seen that the stock is giving a breakout, and the kind of buying interest that any small declines can be seen is remarkable. So recommending a buy here with a target near 660 odd levels and a stop near 622 zones.
All right, Ashish Gupta joins us now, CIO with Axis Mutual Fund. Let's understand from him what he makes of the current market construct. He tracks the banking space. Yes, I've interacted with him in his previous avatar with a magnifying glass, so he's got a very deep understanding of what is happening there. And in general, let's understand from him what his take is on the global macro. So Ashish, so nice to have you on ET now. Thank you for joining us. What do you want to start with? Banks, macros or valuations?
Whatever is your preference.
Okay, let's start with the macros. And it was more like a bolt out of the blue when US Fed actually upgraded their guidance or US economic guidance for next year. What would be the implications of that? Because at the beginning of the year, the narrative was that US will slow down or hit a patch of soft landing and China will come back and it will surprise everybody. Well, the surprise has come, but it is opposite of what we anticipated.
Sure. No, I think you are absolutely right. The global macro has surprised this year, but I think the positive surprise has primarily been only from the US. And if we look at global growth in aggregate, while US has surprised positively, Europe has surprised negatively, and China, as you mentioned, has been a negative surprise. But even more concerning is the fact that some of the challenges with China appear to be a bit more deeper and structural rather than just cyclical. And that means that this headwind for global growth, because as you know, China for the last 15 odd years has been one of the power engines for global growth, is going to last. And what this means is that global growth is likely to be just about 2% or sub 2%, not just this year, but probably next year, despite the fact that the Fed has raised its outlook from about 1% to 1.5% for US GDP growth for next year. Even there, I think we should also not take the Fed outlook at face value. Because if you watch his interview, actually the Fed was at pains to highlight that a lot of its forecasts are just that, they are forecasts. And they actually downplayed the importance of their forecast and the dot plot, and highlighted that moves from here on will actually be really much more data dependent. And I think that is something we need to keep an eye on, because I think we have to be prepared for a much higher bout of volatility, because central banks are moving into really a space of uncertainty. I think it's not very clear whether rates are going to stay high, rates will come down, whether central banks will be hawkish or dovish. And for the last 13, 14 years, we have seen central banks set the mood for the markets. And we have seen that this year as well. During the phase, the Fed was hawkish. The markets did not do well. As the Fed became more dovish, or markets saw Fed getting to a pause, the markets have rallied. And in the last few days, again with the hawkish Fed, we saw a correction. So be prepared for higher volatility, as I think central banks' actions are more uncertain.
Ashish, what would be the short-term, medium-term and long-term implications of the fact that now Indian bond market could be part of the global portfolio? Because we are looking at big numbers. That's what the numbers are floating in the morning. If those numbers of $350, $400 billion are to be believed, then my friend, we are looking at a titanic shift in terms of inflows into India.
Yeah, so I think it's certainly a very positive and long-awaited development. there is no doubt it will lead to significant inflows into India. And again, just near term, because of inclusion in one bond index, estimates are about $22 billion coming over the next few months, a couple of $1 billion coming in every month. And as some of more bond indices follow suit, this number can go up 2-3x from here as well. I think the long-term implication is going to be, I think, the fact that we will have to be a bit more fiscally responsible and more consistent. Till the time our debt was largely internally owned, I think we had a lot more flexibility. I think as fixed income markets also get integrated with the global fixed income markets, we will need to ensure that the macro fundamentals are stable. So I think that's really the long-term implication. Short-term, of course, we know it means that there will be some boost to the currency market, some boost to the fixed income market. But really, we should realize that at the end of the day, for India, the tone of the markets are set by what RBI thinks, right? And if there are these inflows, what happens to liquidity is actually all determined by the central bank action. So even if there's inflow, the RBI can take a view of how much to sterilize or how much liquidity to get into the market. I think what this means, and the buildup of forex reserves on back of this, will also mean that RBI will have a lot more independence in running its monetary policy and not be as dictated by what necessarily happens because of global central bank action. Last 12 months have already shown that RBI has been quite independent, has not followed every Fed move, either in magnitude or direction in terms of rate. And I think as we build up the forex reserves even more, I think that will give us more confidence to drive our monetary policy based on whatever fundamentals are, what growth, inflation, unemployment is doing in India.
You know, Ashish, we're not talking today, tomorrow, but we're talking this money coming in a year from now. And having said that, we're expected to reach the maximum weight of 10% as well. Where do you think within equities money will find its way? And is it going to be the usual suspects, banks, consumption, or you think newer pockets like defense and railways could also find, some money coming their way?
Sure. So first of all, as you know, this money directly comes into the fixed income markets, but yes, to the extent it drives the overall liquidity into the ecosystem, I think there can be flow of money into the equity market. As you guys mentioned earlier in the show, the rate sensitives are driving the market today, because it means that there is potentially an easier outlook on rates with the improved liquidity. And therefore, the traditional beneficiaries like bank, NBFCs, real estate would be the first port of call. I think to the extent that it further provides an impetus to the investment cycle and capex, the industrial names and some of the sector you mentioned will also benefit.
Ashish, now let's spend some time understanding banks, and I'm talking about Indian banks per se.
Yeah.
Whatever could go right for banks has gone right. Credit of stake is strong, NPAs are low, NIMs are great, retail banking is moving higher, UPI, technology, everything is just going so right for them. Yes. So when everything goes right, we normally say that stocks are priced to perfection. Is that the challenge with banks now?
Actually, that's the good part, and I think while we struggle for valuation in many parts of the market today, fortunately we don't have that challenge in the banks. And many of the banks, if you see, even the leaders are trading at multiple that are 35% lower than their peak multiples. So I think valuation is probably the least challenging at the banks at this point of time. I think one of the reasons for that has been that the move in the Indian market has been a lot more broad-based over the last 3 years. And this has happened because it has been a broad-based economic recovery. In the last decade, we saw the move in the economy had been much more narrower. As your colleague mentioned today, there are defense names doing well. There are railway names doing well. You look across sectors and market caps, companies are doing well. So I think that has meant that there has been more choice for the investors to have investable companies. And that's meant that banks have still headroom in terms of valuations.
Now that you've changed sides from sell side to buy side, tell me which is one sell side advice you would not like to follow now that you've come on the buy side?
I think
Come on, you can be honest.
No, the only thing I would say is that on the sell side, typically we had 6 months to 1 year views on our target prices. I think in the funds that we run, the size of the funds we run, we have to perforce take longer calls. So we need to have much more multi-year views reflect in our portfolios and really not get sucked in by the noise that is there.
Behind the backdrop, just a coincidence, is it? I can hear the noise in the studio. Can you hear it? I think it's a backdrop. We're talking about noise.
Yes.
Just a coincidence.
That's part of the capex boom.
It is.
Okay. So closing comments. From what to your mind would be the importance of next year's election? Because the election in India has been a binary event. As a fund manager who has to manage risk and also stay invested, how would you manage the election volatility?
So I think there are two things we need to take into account, right? And one is the volatility on the day of the election. And if you go back to 2004, 2009, there was very big volatility when results came. Election results came in a very stark contrast to what the market expectations was, and there was a big drawdown in the markets. But the reality proved to be very different. The governments that came in kind of delivered different outcomes to what the market was fearing. I think if we look today, I think whatever opinion polls that we are seeing, it does not seem that election results will provide a huge surprise. We feel that there is a significant degree of consistency that has kept into many of the policy making space. A lot of things have been made structural. So, for example, simple things like the vision in fuel prices, right? So some of these decisions have become structural, have got ingrained in the policies itself. Frankly, to my mind, that is not something we are worrying about too much. I think more near term, but we are very focused on is seeing how consumption plays out in the next 6 months. I think consumption growth in India has not really picked up as expected over the last 2-3 years and has lagged expectations. I think this festival season is an important time where we need to see some bit of discretionary consumption coming back in. We are also hoping that rural consumption also starts to move up. So I think pickup in consumption for me is really a space that I'm watching more closely rather than I think worries on the election.
Well, Ashish, appreciate your time and so glad to have you back on ET now.
Okay, thank you so much. Thanks for having me.
Markets, meanwhile, they're just about holding on, but there is a real party in the entire EMS electronic manufacturing space. Jairam Sampath, whole-time director and CFO with Keynes Technology, joins us. Good morning. Thank you for joining us. First HNI investors, then institutional brokerages, and now retail brokerages. Are you surprised with how suddenly everybody's excited about the EMS space?
Yeah, so in our journey for the country from a low income group to a reasonably sized income, I think one of the things which was lacking in our country was the impetus to manufacturing. And I think it looks like electronics manufacturing is going to be the flag bearer of the emergence of manufacturing. I wouldn't say resurgence because we always had not too much of manufacturing on our plate. So yes, I'm not surprised that across the board people are excited and they are lending their support both morally and fiscally.
In your big deal wins in last 3 months, which give you the confidence that the Renaissance moment has arrived?
Yes, I think these are, let's say, times of tipping point, right? So you would see sudden shifts and you would see lots of improvements and almost every day is going to be an exciting day. So I would say that all the people who are participants in the markets and in the industry now probably are participating in a kind of a revolution of sorts. And I think next 5 to 10 years will definitely prove to be highly engaging as far as the manufacturing industry is concerned. And the why I say this is because there is evidence that it's here to stay, irrespective of all other major economic forces, etc. This particular activity is here to stay.
Right. So, Mr. Sampath, since you are painting such a bullish picture, not for today, tomorrow, but in 5 to 10 years hence, tell me, you had given a revenue target of 1,700 crore rupees in FY24, right? Now, with this added momentum for the sector, the focus by the government as well, and the order inflow, suffice to say that you're going to be revising your guidance upwards for FY24?
Yeah, so we had said it will be upwards of 1,700. Maybe it is more like 1,800 crores right now. And a lot of action will happen in the third and fourth quarter of this fiscal year. Because it takes a little bit of time on ground realities to change, the capacities to build up, orders to flow in and so on. But certainly FY25 also is likely to be pretty good as we see it now. And we are in the process of making sure that we get all the capacities ready to address this. So yeah, 1,800 crore is something that should be on the cards now.
You know, the street is quite excited about smart meters, especially now that the government has also taken steps to boost the manufacturing. Tell me, what kind of an opportunity does this throw for you? And currently, as a percentage of your revenues, what's the portion of smart meters in your business?
Yeah, so presently, just to some facts, presently we do manufacture large number of energy meters and a smaller quantity of smart meters. Smart meters is a new program government has initiated, and it is in the process of finding its feet, so to say, in the implementation scenario. There are 250 million smart meters have been the target. And of course, government is quite, let's say, optimistic that they would do it in a few years' time. Maybe it takes a little longer. But in any case, it represents a huge opportunity. So at this point in time, smart meters may be a very small proportion of our total sales because ours is a highly diversified sale. But then, like all other industries, this is one of the hot sectors, one of the many hot sectors that we have in our portfolio, starting with, of course, driven by government's energy policy and smart meter implementation. And I think last year and the year before, government has spent some time in understanding what is the model that works and how to make sure that the consumers get benefited, and also how to make sure that the objectives of the energy policy is also reached. So going forward, you will see a lot of action in this area. And the numbers that you actually see on board for many companies in smart meter area are far lower than what actually is going to happen. So we are also excited to be a small part of this movement. And going forward, it won't be a huge percentage of our business, because we also believe that our business should not depend a lot on one or two or a few product categories. But suffice it, it will be significant, and we look forward, at least this year and the next year, reasonable revenues in this space.
For Cairns and for the entire AMS sector, there is one huge tailwind, and that tailwind is China Plus One. But China Plus One is more like a policy initiative, where the European and especially the US government has imposed a ban, or they put import restrictions on manufacturing which comes out of China. Now that could change. That is something which is completely political. It is policy which is at play. Isn't that a huge risk for the entire EMS space in India? Because you don't know what policy framework will happen.
Absolutely right. Absolutely right. In fact, that's what I've been saying also. So this Atmanirbhar Bharat concept, which probably was put forward sometime in 2019 when the current government took charge second time. And so that essentially means that you manufacture for India. Earlier, the concept was to manufacture for the world, and obviously, world has lots of its own idiosyncrasies, and they look at other things other than just economics to do business or not to do business. And it's very volatile and it's very brittle relationships, as you know. So, in order for us to look at this sector, I think we should look at the import substitution bit as the first driver. The second driver is government's implementation of several reforms in the country, which leads to a lot of impetus to electronics manufacturing, be it energy sector, wherein the new energy policy, smart meters and stuff like that, power distribution equipment, then railway improvement of safety and the improvement of railway efficiency, like signaling products and the Kavach program and so on. Then there is IT sector. Already government has made clear its intention that all the manufacturing has to be done in India. Yeah, they have given some little breathing space for people so that they can deal with their customers' demand in the short term. But in the long term, IT, including servers and so on, I think government is also working a lot towards improving the backbone, IT backbone of the country, because just the mobile phones add the possibility and potential, but the actual capacity is added only when IT backbone goes to the villages. So IT policy and so on. So these, and telecom, of course, we are not even talking about 5G right now, but that's again going to be driving the electronics manufacturing. So irrespective of whether China Plus One happens, China Plus 0.5 happens, or China Plus 0.25 happens, I mean, maybe the Chinese government will also take some countermeasures to prevent people from shifting out and so on. So yeah, it may be wherever it is, but I think as far as Indian manufacturing, especially electronics manufacturing, is concerned, it has arrived on the shoulder of more robust demand, let's say, factors than something which is dependent on either a geopolitical situation evolving in some particular manner and so on. So I am quite happy that we are actually standing on shoulders of already something which is imported by India, and we're trying to do it in India, plus government's let's say, minimum program of making sure that India becomes a good economic superpower in terms of in critical areas like infrastructure, energy, telecom, transportation, and so on.
Just a quick word before we let you go. So do you think that these margins of about 15% look sustainable?
Yeah. Okay. As far as Cairns Technologies business portfolio is concerned, it's based on order books. Like we said last time, we declared that 1st of July, our order book was 3,000 crores plus. So we pretty much know that the margin profile and the eventual PAT profile will be what they are currently. It's somewhat better because we get some operating leverage and so on. So yes, I think we will retain this.
All right, appreciate your time. You sounded very optimistic and given lots of growth targets and levers to work with, and good to have you on board. The stock price of Keynes Tech is holding out in trade today. We'll take a quick break, but come right back because we've got an interesting discussion lined up. We talk about the turbulence in the aviation sector, what's lined up for that space, what does it mean for individual players. Come right back. Back with first trades right here on ET now. Flat line for the index at around 19,733, and looks like it's the broader markets as well that are following neck to neck with the frontliners. There's been a lot of turbulence in the aviation skies, particularly back home. So let's discuss what exactly this means for the individual players, for the industry as a whole. We've got Anand Singhal. He's team lead at Kappa India, as well as Mayur Milak, who is the Senior Vice President, Auto and Aviation at Asian Market Securities. Thank you both for taking time out and joining in. I wanted to, Anand, get in your view first, just from an industry perspective, and I'll dive straight into it. There have been a lot of issues related to the aviation industry of late. Flight cancellations, pilot resignations. I just want to understand what exactly this is indicative of for the Indian aviation sector. Do you think that we'll tide over it soon enough?
Well, pilot resignations right now, before I answer your question, I'll have to provide some context. Right now, we have about 135 aircraft of Indian carriers that are grounded. Now, with that in mind, the pilot shortage that we would have expected is somewhat better, so to speak, because 135 aircraft are on ground. As and when these aircraft start flying again and new inductions come in, the challenge of pilot shortage will likely to go up, and a lot of airlines are expected to face challenges with this area. So right now it seems to be somewhat manageable, although lately because of the 40 resignations, about 80% of the schedule had to be cancelled. But overall, for the industry perspective, the issue of shortage of pilots is somewhat manageable. But when these aircraft start flying again, it'll start be creating challenges for the industry.
Mayur, specifically to Akasa, if one looks at what has happened in terms of Akasa pilots going to Air India, do you think legally there could be a challenge like this? Mayur, would you like to respond to my question?
Sure. So, so typically this is an arrangement between the pilots and the company, right? I mean, we keep hearing these things in the past as well. To be very honest, what is really the outcome? I don't think there is any legal way to understand what is the broad outcome. But yes, I do understand that it puts a lot of pressure and chaos on the entire network. So no doubt, Akasa seems to be super concerned about this issue. Yes.
Anand, when GoAir aircrafts were grounded last time, it led to a spike, an unusual spike in some of the routes where GoAir was operating. Now that Akasa on an average has cancelled about 400 to 500 flights, and the number was there in July, the number was there in August, the number is there in September, it could increase again in the month of October. Could this have impact on the yields, and could this have impact on the fare prices also, Anand?
I missed some of what you were saying, but I assume you're talking about the flight cancellations and the impact that can have on fares. Am I right? Hello?
I think there is a bit of an audio problem there with Anand. Maybe we want to fix it up. But Mayur, can I encourage you to come in on that same point?
Yeah, so clearly, yes. I think whenever there is a supply disruption, you do tend to get the impact on the fare prices. Actually, I would actually have to believe that you are now going to enter the peak season. So October, November, December typically is the best months for the aviation companies to make money. At a time like this, when your demand is really going to be high, and if you have supply issues at any of the peers, it definitely opens up a huge opportunity for the likes of Indigo. No two things about that. So yes, They are the only ones who are capable to really make up for any loss that happens to any peer airline at this point in time. So they will stand out as a strong beneficiary of this chaos. No two things about that.
Okay. Mayur, in terms of the role, do you think, where do you think the entire aviation industry per se, Mayur, is headed? Do you think it will be a two-player market or it will be a four-player market? Because, Akasa will scale up, Jet, yes, no continues, Go Air may come back. So where do you see the dynamics of the aviation sector in India moving? Two large players and two, three small players? Or it will be only two large players, that's it, end of the story?
No, I think it is not good news, if any market is a duopoly market, to be very honest. So, we are a growing industry. We are too small in terms of penetration at this point. So clearly, a two-player market is not the ideal theory. I mean, yes, as an analyst, as an investor of Indigo, I'll be happy. But for the long-term game to really, make sense, this industry has to have at least 3 to 4 players, each competing, so that the customers can really make the best out of this. So clearly, there is room for other players to come in, and we will always look forward for that to happen.
So, Anant, I think wanted to get in your take on something that will impact the likes of you and me, the air ticket prices. We understand that owing to the shortage, etc., we're likely to see close to a 20 to 30% jump in airfares. Is that really what is estimated, even given the rise in crude oil prices? What are the estimates in terms of ticket fares over the next few months?
So, before I come to the next few months, first quarter of the fiscal, we had a very, very strong yields that the airlines witnessed. In the current fiscal, which is ending this month, there was a dip of about 15 to 17%. Coming to the next quarter that you are talking about, it again will be robust because the demand will increase. And there will be an upward swing we expect some upward swing in the fares and in the yields that airlines earn. So yes, that will be there.
Okay, would you like to comment on that, Mayur, in terms of, some sort of an estimate as to owing to all of these factors, what could be the potential rise in air ticket prices? Is 20 to 30% a fair estimate, or is it a little bit unjustified?
No, so if you talk in terms of RASK, so we saw at least Indigo make a RASK over ₹5 in Q1. Q2 is always a dull quarter, and typically Q3 is by far the best quarter for the industry. At the current scenario, even with crude prices going up, I clearly believe that to look at something like what they achieved in Q1 is the least minimum. So yes, clearly a 25 to 30% jump is very much on the cards. I will not be surprised if it goes even beyond, looking at the demand that really happens in this festive season.
Whoa, beyond 25 to 30% is what you're saying could be possible. That's not going to spell out good news for us. But Mayur, what about your outlook on SpiceJet maybe? Because it is a formidable second player in the industry, but market share has really dropped. Akasa could have a major role to play in that. What is the outlook when it comes to SpiceJet over the next few years? Because it's just not been able to revive its market share. There have been niggling issues one after the other.
So officially, we do not have it under our coverage. But as far as the industry goes, I think, yes, you're right. They've lost a lot of aircrafts due to non-payment issues with the lessors. From I remember from a fleet of, I think, 100 plus somewhere in FY19, they've come down to about 22, 25, which is almost cutting off more than two-thirds of its peak fleet size. So yes, trouble brewing at SpiceJet. I think they need to sort their financial issues with the earlier promoters as well. So a lot going on there. Clearly, they will not be in a position really, to take advantage of any chaos that would have either happened at the time of Go Air, or for that matter, even when Akasa seems to be in a little cancellation more trouble. I think the only two guys who could really make something out of this is either the Tata Group through Air India Vistara or Indigo at this point.
Okay. So, Anant, just wanted to understand, in your experience, have we actually seen any airline which has shut shop once they restarted their operations? Jet Airways continuously facing hurdles. Go First, how are you looking at operations faring on that front?
So Jet Airways not starting till now is sad. Although we hear in the media that the resolution plan will get implemented soon once the payments are done. However, as far as Go is concerned, it's a great asset, so to speak. There's a lot of talk about many potential suitors that are interested. So if the process were to be completed quite quickly, then yes, a turnaround of Go seems feasible. However, I can't get into the specifics of that because, as you're aware, it's still an ongoing process.
Okay, Anand, Mayur, both of you, thank you so much for taking the time out and joining us today on the show and giving us perspective on what's really happening with the Indian skies and quite a bit of turbulence. Be ready to dish out more for flight tickets going forward. On that note, we're going to take a very quick break. PSU banks holding out, Nifty absolutely flat.
Welcome back. It's an absolutely flat market at hand. Just running you through some of the losers within the broader markets. Glenmark, Cochin Shipyard, MMTC, Aurobindo Pharma, as well as Garden Reach and KPIT Tech are some of the key drags in trade today as we're staring at 19,700 and perhaps on the brink of even breaching that level on the downside. But a big voice then lined up for you. Oil prices have been on the boil over the past few months. The gains following the extended production cuts from Saudi Arabia and Russia have led to it, and feeding those supply concerns, OPEC Plus members in Saudi Arabia along with Russia have extended the combined supply cuts of 1.3 million barrels per day. How is demand shaping up, and will OPEC Plus cut boost supplies over the near term? My colleague Ajay had a chance to speak with Dr. Faridun Fesharaki, the chairman of Facts Global Energy, to understand the road ahead when it comes to oil prices. Listen in.
Well, the first thing to keep in mind is that it is, after all, supply and demand on the one hand, and the other hand is sentiment and fear. As far as supply demand is concerned, the demand side is very strong. The demand this year is 2.4 million barrels per day of growth, of which probably 2/3 of it still is COVID recovery. And out of this total, 65% is in Asia. And from the 65%, half of it is China. So China is still very, very strong. But this is the last year of COVID recovery. Next year, it will have to be based on fundamentals alone. Fundamentals alone show a demand growth of about 1 to 1.2 million barrels per day. But the COVID recovery has doubled that. So the demand side is very strong. On the supply side, OPEC Plus has been very diligent, and they've been holding the supplies back. They want to see the prices in the $85, $95 range. And we are close to $95. It probably is going to stay between 90 to 95, maybe a little bit below 90, but I doubt whether it would hit 100 or not. But on the other hand is the concerns about the financial markets. Worries about recession, worries about the Federal Reserve rate increases. And every time one bank goes bankrupt in the US and Europe, then there is all negative sentiments as far as oil price is concerned. But actually, the fundamentals are pretty sound as far as OPEC is concerned.
I'll go back on that point once again before we move forward. What, to your mind, Saudi Arabia and Russia's stance to really extend the voluntary cuts by 1.3 million barrels a day, what triggered that? Is it the urge to gain more market share in a world which is kind of weakish on the demand front overall? What, to your mind, and could it go beyond December as well, in your view?
Well, it depends on what the assessment of mainly the Saudis are, that what the market will do. I mean, let's assume the Saudis decided not to extend the voluntary cuts. The prices would have probably gone down to mid-80s. So the Saudis want the prices to stay strong, because they worry that all of those fears about this negative sentiments about the financial sector would intervene and make the prices go lower. So they would like the 85 to 95, and they are pretty much there already. Question is, what happens next year? And next year, we think the demand growth will be much smaller than this year because the COVID recovery phase is over. The OPEC says that still expect 2.4 million barrels per day growth. Many people, including ourselves, think that the demand growth will be maybe 1.2, 1.4 million barrels per day. If indeed the demand growth is lower, then OPEC needs to continue to cut back. And how far are they willing to cut back? And will everybody participate or not? This is something that is yet to be determined.
Net, over the next 12 months, what range do you see Brent crude trade in, on the upper side and on the downside?
I think on the downside, probably will not go below 80 because the OPEC Plus will not allow it by trying to control the market. But there could be downward pressure on the market because the demand fundamentals are not going to be the same next year as this year.
Some interesting takeaways there from Mr. Fisharaki talking about the projections for crude oil prices. But we've got a listing today that's lined up for you, and that's Samhi Hotels. Given the fact that the company is loss-making, the fact that, there wasn't a great response as well, let's see what the listing is because it's expected to be a little bit muted. 126, that is what the issue price is, and that's the listing of the day. 130, so a mild premium of about 4 to 5%, and that's pretty much what the street as well was penciling in when it comes to Samhi Hotels. Just a little bit more as well, a little bit more about the company. Remember, they're a branded hotel ownership and asset management platform in the country. They're the third largest in terms of the operational keys in India as of the 31st of March. But yes, when it comes to the fact that it's a very competitive market, the company has been making losses, debt as well as high. That's perhaps the reason that you're seeing a muted debut on D Street. All right, we'll take a very short break. Be right back with lots more.
Back with first trades right here, Nifty now, where the index is definitely drifting a little bit lower after what looked like a quiet start thanks to PSBs. That has really gotten challenged, and we've now breached the 19,700 print as well on the Nifty spot. In fact, the broader end of the market as well is getting a little bit more wobbly, and now at least within the F&O universe, you're favoring the declines. It's a 110 count there. Berger Paints, Glenmark, Cipla, Oro Pharma, Birla Soft, these are your rank underperformers. And within the Nifty as well, it's actually Pharma which is taking a step back, led by Cipla, Divi's, Dr. Reddy's, Sun Pharma. They're all big drags today on the markets. In fact, since we're talking about pharma, let's really understand what's going on with the sector. We have with us Nithya Balasubramaniam joining in right now from Sanford Bernstein to talk about the ongoings in the sector and what it could look like down the line. Nithya, great to have you today on ET Now once again. Thanks so much for taking the time out. Nithya, let's first address the so-called elephant in the room, and that's always been US markets, right? Has pricing erosion further eased? What is the situation when it comes to the drug and the injectable shortage? I mean, is there more to the ray of light for trade generics?
See, in the US, we do see pricing deflation has softened, especially compared to last year. We think pricing deflation was trending at minus 15, minus 20% even, depending on the portfolio. And we think that's down to low single digits this year. And I think that has now been consistent commentary from most of the players, most of the Indian generic companies, as well as some of the global MNCs as well. If you look at what Teva's been saying, what Viatris has been saying, I think all of them are consistently calling out that the pricing environment is softer this year. And on top of that, as you were talking about, we are seeing some supply disruptions in the market. We have seen some players recall some products. We have seen some players file bankruptcies. So these will therefore create opportunities for players with a wide portfolio. So Dr. Reddy's or Aurobindo, These are companies that have a pretty wide portfolio in the US, so it's more likely that these companies can benefit when these one-time disruptions happen, provided they have flex capacities, right? So I think that is still true. We would expect that to last at least for the next couple of quarters. Beyond that, we'll have to wait and watch. I think the competitive intensity hasn't really changed. If you look at any new product that's seeing generic competition, you're still finding 10 to 12 players, right? And which means your prices will erode down to 90-95% levels. So that we haven't seen a change in yet, but definitely this year pricing deflation is softer.
But will it stay at the current levels, or as cyclicality and global volatility kicks in, new launches around the corner, price erosion will start again?
See, I think, as I said before, what is required for companies to do, let's say, double-digit growth is not just what is the erosion in the base. You also need to think about what new products they have to launch. Even if you assume that price erosion will remain at the softer levels that we're seeing now, maybe 5%, 6% on the base, you still need several new launches that you need to launch in the US market to be able to cover up for that base erosion and grow on top of that. So I do believe price erosion can remain at these levels, but I'm not so sure people have the ability to grow double digit even if price erosion is soft. Especially if you do not have complex generics or biosimilars in the pipeline.
For next 12 months, if you have to look at the big picture view of the Indian generic companies and their product pipeline, is it looking exciting? Is it looking dull?
I wouldn't say it's exciting across the board. I think it's exciting for some companies. If I look at the next 12 months, we do believe that Cipla can launch a couple of interesting assets, generic Advair or generic Abraxane, for example. They are now transferring it to alternate facilities. Hopefully, they'll come through in the next 12-month time frame. Lupin, for example, already has a Spiriva in the market, and their market share gains have been pretty good. So I wouldn't say that it's a secular trend across the industry, but depending on your product portfolio, depending on the competitive landscape of your launches, there are some names I think that will do better than the others. Cipla and Lupin, for example.
Enjoy reading your report. Cipla, Blackstone versus Torrent Pharma, showtime, let's do it. So let's talk about Cipla. I'm going to construct a scenario here. There is a deal with a Torrent. What happens then? There's a deal with a private equity player. What happens then? And there is no deal. So in these three scenarios, unless there's another fourth scenario, which you can flag off for us, if these three scenarios are at play, what happens to the shareholders of Cipla?
See, I think in the last couple of days is when again news had broken that Blackstone is probably not going ahead with the deal. Again, I'm basing it on the press releases that I'm seeing. I don't have any incremental information there. So it seems like Torrent is the one serious suitor who does remain in the fray. But I think the challenge for somebody like any private equity was always how do you unlock the 20-25% IRR that you normally look for when you're investing in an asset like this. It's a relatively well-run company, so we didn't really see any immediate quick wins that they could go after to unlock value. That's probably why Blackstone is maybe backtracking. Torrent, I think the strategic rationale is clear. I think we actually did this analysis of looking at their India portfolios together. And while there is overlap in terms of molecules, what we found was that it's largely manageable in the sense that even in the overlapping molecules, one of them have like significantly high market shares. So therefore, it might be easy to either sell the smaller brand or retire the smaller brand. So we think the overlap is manageable. It'll obviously create, you put the two together, it creates the largest domestic pharma company. And of course, the combined might of the PNL could make them a bit more bolder in terms of other capital allocation choices. But in that report that you mentioned, we had called out that it won't be an easy task for Torrent to find the monies that would be required to close this deal. In this specific case, the promoters of Cipla obviously want all cash. Not an easy one for Torrent, which is a smaller company. We have now, in the press, heard of a mix of Apollo, JPMorgan, CVC, Bain Capital. All of them seem to be involved in some capacities. So maybe they're successful, but it's going to be a tough one in terms of how they raise the monies. If the Blackstone deal or the Torrent deal is going forward, I would imagine it's a positive for the Cipla stock. But if either suitor and both the suitors actually fall out of the race, I would imagine the stock will actually react negatively.
But why are there so many deals which are at play? The Glenmark Nirma deal was announced yesterday. Cipla is in the works. I mean, typically when there are deals or M&A happening with private equity investors interested in it, it just tells you that the sector per se is either going through consolidation or there is a major revamp which is around the corner.
I'm not sure I can draw any lines between what's happening with Glenmark and Cipla. Cipla is in a very, very different part of its maturity, if you will. They're now in a place where the third generation is likely not interested in taking on an operational role. And that's probably why the Hamids are keen on selling their stake now. I'm not sure Glenmark is the Glenmark deal that happened is a similar one, right? You still have the Glenmark promoter involved in the parent company. This seems to be more towards generating cash and unlocking value for the API business. I don't think I can draw any parallels here.
Let's say 2-3 years out, if you have to talk about two situations. One, where are you confident of growth and earnings, but stock is expensive? B, where you're getting a combination of moderate growth and a high margin of safety. Where do you think these two factors are at play in this universe you track?
We think from a 12-15 month perspective, we still like Sun and Cipla. But I think given all the flows that the sector have seen, they are relatively more expensive. And therefore, I'm not sure they're presenting an entry point right now. But when we look at the fundamentals, we continue to like Sun for their specialty exposure. We think there is more operating leverage yet to play out. In particular, we're looking forward to the approval of the Duroxolidinib asset in the US, and that's going to take another year or so. And in the meanwhile, we'll also find out more about market acceptance of alopecia areata drugs. So that's what we're looking forward to with respect to Sun. Cipla, again, we think they have multiple shots on goal in terms of complex generic assets, respiratory generics or peptide injectable assets in the pipeline. They haven't disclosed many of these assets. So the closer they get to approval, earnings upgrades are likely to happen for that stock. But of course, I think in the near term, it's going to react based on what's happening with this stake sale. So these are two names that we like. From a long-term perspective, we think growth will remain consistent and strong. However, possibly not an entry point right now. Biocon is the other name that we like, where we think valuations are attractive. And we believe earnings acceleration will happen in FY24, FY25. We fundamentally believe that the biosimilars market in the US is more attractive than it was in the past.
It's great to have you on the show. Thank you so much for taking the time out. And, it's always great hearing your thoughts on the pharma sector.
Thank you for having me.
Okay, let's just take a quick stock of what the market is up to, because we've definitely slipped from that quiet start that we had today. We're now sub the 19,700 mark, while PSBs definitely are holding out. The rest of the market is not. On that note, let me take it across to Kunal and find out what are the stocks that he's spotting. Kunal, what's on your radar?
So it's Granules, and this is more of a longer term charts for Granules. The stock over here, the price charts over the last 6 to 7 years, and the indicator mapped up. Now, interestingly, the indicator is on the verge of giving a breakout on the monthly chart for Granules. Now, look at the historical context. Whenever the stock has given such a kind of an indicator breakout, we've actually seen the stock going into a very strong momentum. Now, the best part about the chart pattern so far is that the stock has already gone through a time-wise consolidation over the last 2 years. We call this typically a flag pattern forming for Granules. So potential breakout about the 350 mark could take the indicator into a stronger breakout mode, as well as the price breaking out of this 2 years or 3 years of sideways consolidation. So this could be a stock which could be a strong breakout candidate over the next 1 to 2 years, expecting the stock to make a fresh high, possibly in that kind of a time frame.
All right, let's get those individual stock calls going as well. And Kunal, what's looking interesting on the charts?
So I'll stick to Bank of Bohra from the PSU banking stock. suggesting a buy with 225 as a target, stop loss at 207. And HDFC AMC is also a stock which is being a bit more resilient. So would suggest a buy with 2,800 as a target, stop loss 2675.
All right, thanks very much. Those are two buy calls coming in from Kunal. All right, let's shift gears then and talk a little bit more about the outlook in the primary markets and Sai Silks as well. You saw the issue that has been decently subscribed. Let's understand a little bit more about the business as well as the growth outlook for the sector as a whole. We've got with us in our studios Bharadwaj Racham Dugu, who is the Senior VP Sai Silks. Good to have you on board. Thanks so much for taking time out. I just wanted to talk about the Indian ethnic wear as a whole in terms of what kind of opportunity you see for the company and what is the growth roadmap for FY24?
Ma'am, talking about Saris Kalamandir, we see that we operate in the women's ethnic wears, especially saris. We sell about 66% of our revenue comes from saris and the 33% comes from non-sari categories in the ethnic wear segment. With that same vision, that's when we started Kalamandir in 2005, targeting the middle income class segment. And soon we've expanded into 4 formats targeting different niche segments. And our product range also starts from 200 rupees to 4 lakh rupees saris as well. Talking about that, the industry is seeing a good growth rate of about 8%. And we operate in the South Indian market as of now. We have 54 stores in 4 states of South India. And these stores are doing phenomenally well. With that same vision, we are entering now into Tamil Nadu market, which has a combined potential of Andhra and Telangana put together. So we have about 4 stores today as we speak right now, and we plan to open about 25 of Varamahalakshmi Silk store and 5 of Kalamandir stores in these markets. And Tamil Nadu as we speak has a great potential. Our old 4 stores are also doing phenomenally well. So it gives a strong indicator for us to see a good growth in the near future.
Purpose of your IPO? How is it that you're going to be deploying the funds?
We plan to use the major funds in the primary by opening 30 new stores. Okay, around 400 crores is going towards setting up of new stores, including capital expenditure as working capital as well. We plan to release a 50 crore long-term debt, and the remaining entire amount is going towards improvisation of gross margins. We plan to do that by leveraging cash discounts and volume discounts with our weaver and vendor community.
So you could have gone to a bank and taking working capital loan. Why come to the equity market?
Sir, historically, if you have seen, the company has grown in a gradual manner as we speak continuously on an internal accrual basis. As we speak currently, entire company is owned by the promoter and the promoter group itself. And what we've understood right now is Tamil Nadu as a market has a strategic advantage because you've seen industry giants playing in this market, be it Nallis, be it Pothys, who have heritage of more than 70, 80 years. So with that strategy, 10 years ago, we opened 2 stores. We knew that Tamil Nadu market is a very, very big market, and the idea right now is to always go in a cluster model in the Tamil Nadu market to expand, penetrate much deeper into it. And in terms of a little bit aggressive strategy and the bank funding, there's a certain cap in terms of the bank limitations and in terms of bank funding. And that's the reason we believe our model is now mature and we have enough bandwidth within our own ecosystem to help us expand to those new geographies right now. And we believe that this is the right time to unlock the wealth as well.
And there is no PE investor exit in this. This is pure promoter holding which will be coming down.
Absolutely, sir. Yes.
Do you have PE investors in the company?
We do not have any PE investors in the company. I think we currently have about 4.5% of the shares being given to our employee trust. Rest entire thing is with the promoter group itself.
Okay. In terms of the size of the South Indian brands, I mean, you've just spoken about 3 brands. Nallis is perhaps something which my recall has been the highest. Right. How would you stack up in terms of size and in terms of growth?
Sir, in terms of size, if you're talking about revenues, I think MCA data is what we could refer to because they are not publicly available data. I don't want to comment much because they have other categories as well as far as I know, not just apparel. They have other jewelry categories to the best of my knowledge. But for us, it's completely apparel play. It's majorly saris and the rest of it also coming from the apparel. So in terms of like-to-like comparison, in terms of listed peers and listed space, there's nobody else I could probably put down into. But broadly, if you have to classify them, each of our formats have a different competition. Like for example, in the likes of Varamahalakshmi Silks, Nallis would be competing. Maybe Pothys would compete with Kalamandir as a brand, and KLM Fashion Mall. I mean, we also have regional players as well. For Kalamandir, there's somebody called RS Brothers. They are again a regional player here. So the competition comes in all shapes and sizes. And talking about the likes of Tatas and Reliance, talking about Taneira, Avantra, they're betting big on saris. That tells that the market is going great towards in terms of the ethnic Indian apparel.
The number what we have, it is 28 times, and that's a very reasonable P multiple. Normally when companies they go public, they use benchmark. So what is your benchmark? I'm trying to understand here, because there is no real benchmark for you.
Absolutely.
A lot of companies which are there, they are not listed and data is not available. So when you arrived at the price of about 30 times, how did you benchmark it?
So again, what we've done is go with the help of the BRLMs in terms of doing a price discovery research. We have met funds, domestic, international funds, and based on their guidance is what we came up. We landed up to this pricing, and we believe this pricing is derived based on whatever the response that we got. And if you look at our anchor book, we've got phenomenal response from one of the marquee investors as we speak, and these guys have both domestic and international presence, and them trying to believe in our story, they're trying to like our story is a testament that we are in safe hands.
Well, when is it that you would look to penetrate the other parts of the country as well? Because like you or yourself said, big players like Tatas are in the market already with their brands, Thanera, and they have the jewelry to go along with the apparel segment as well. So when do you move beyond the TN geography?
As we speak, ma'am, I think the DRHP and the RHP limitations, I'm only talking about the next 2 years, these 30 stores. But we chose South India to begin our journey. If you look at strategically, right now we're selling 2/3 is saris and 1/3 is coming from non-sari categories. The core of what we do is I think the company is safe to say that we are more like a technology company trying to sell Indian ethnic wear. Because we believe when we try to enter into newer markets, we do a thorough analysis in terms of target market, in terms of product mix that needs to go in each and every store. Hypothetically, if I have to enter into newer geographies, my product mix will change based on the local geographical preferences. But we definitely, once we are able to cover the South Indian market, we'll slowly start coming into the other markets as well. Today, if you look at our 54 stores, is only coming from less than 12 cities. If you have to talk about Tamil Nadu, we have any presence. In terms of Kerala, we have not even there. These are also the markets that for us, we can penetrate much deeper into these markets. Beyond this, there's definitely the entire pan-India presence will definitely be there. And to your question of what about Tatas and Reliance, I think what's happening is major shift is going towards unorganized to organized. And these players are actually the key drivers for us to go there. We believe because sari as a market needs to be connected with the roots, because there we procure our products from more than 80 cities. We have a weaver and vendor network across north, east, west, south. Wherever a sari gets weaved, we tend to be there. With the help of our technology, with the help of our sourcing support, we believe by the time the other players expand into other markets, it will become a level playing field. And because we have organized practices that we follow, we will be a good competition in these newer markets whenever we enter into that markets as well.
But don't you think you, like the Tatas, will also have to eventually try and diversify your portfolio, not just apparels, but jewelry and other segments as well, eventually?
Ma'am, for us, I think the model has been very focused in terms of selling saris and apparel wear to begin with. We believe generally what happens is we do not want to diversify into other categories at this point of time. We believe there's a great amount of growth that's been backed up by SSGs and the industry growth plus the unorganized to organized shift. So at this point of time in near future, we do not see any kind of diversification in terms of our product profile.
And what about your financials? How long does it take for a new store to break even? You have a PAT in FY23 of about 98 crore rupees. How do you see that scaling up and your revenues of 1,300?
If I have to give you an example of a Varamahalakshmi silk, generally every format is different. Let me just give you an example with one of the formats, Varamahalakshmi silk's format. Varamahalakshmi silk format, the capex requirement will be around 5,000 is the average square feet, and 5,000 rupees will be the average per square feet capex cost. So that puts about 2.5 crores. And the inventory requirement will be around 20,000 rupees per square feet. That's around 10 crores. So broadly around 12.5 crores of investment per store. Talking about break even, Varamahalakshmi Silks does about 50,000 rupees per square feet. 48,000 rupees per square feet is the average revenue per square feet, which is much higher than any organized or unorganized players where we see. And with that number, I think it's safe to say that capex payback will be around 4 months to 5 months. And with respect to the inventory, it will be around 16 to 18 months.
Wish you all the best. Thanks so much for taking time out and joining us in our studios.
Thanks
That's the view coming in from Sai Silks. Tell you what, we'll take a very short break. Be right back with more news and updates. Don't go anywhere.